Let's connect with Shankar Sharma, Chief Global Trading Strategist with the First Global. He joins us from Dubai. Shankar, good morning. Thank you for joining us. Shankar, 2014 is not off to a great start. Not only locally but globally also, money is moving out of equities. What is suddenly fueling this risk of momentum? China, emerging market currencies, or general risk aversion?
Well, there are two aspects to this. The global macro part is looking worse and worse, in particular for the emerging markets. They have been looking bad even last year. I mean, I think EMs were about flat to moderately down 2%, while the US was up, I think, 23-24%. So there was a huge performance divergence between EMs and the developed markets. The EMs continue to be weak. I mean, this year they have been doing rather badly, except India as a lone exception. But more importantly, the sense I have, my gut is that this year will be actually a big down year even for US equities. And that flies in the face of consensus. Consensus right now is that emerging markets won't do well, but developed will do well. And so hence now that is the consensus trade. I suspect that this year will be the year in which that particular consensus trade will break. Which doesn't augur well for either the developed or for the EMs, because if the S&P falls, I mean, I really don't think EMs are going to have a up year, right? So basically everything will be down this year in 2014. I think the first part of the year will see developed markets lagging emerging markets. But thereafter, I think it will be pretty much a slide which will, take no prisoners. I think we will hurt all across the board. Now, India has been doing remarkably well, and that I have said many times on your show, that's due only to one factor. And the only factor that has led India's outperformance from let's say the lows of July, August, has been the government's moves to curb the current account deficit. Moment that was fixed, the currency depreciated for sure, but it did not go into a free fall like the real has done, or many other currencies have done, even in this year itself. So the rupee depreciated and then has halted around the 61, 62 levels, making it a very competitive currency, and that has encouraged FDI investors to look at India, and obviously that has encouraged FIIs to look at India in relation to the other emerging markets. And more importantly, that's also given Indian exporters a lot of sort of tailwind to generate additional economic growth. So overall, the reason why we are ruling at near about the highs, while you look at across emerging markets have been crashing, is only because the government has fixed the big problem in the economy, which was the current account deficit. But the fear I have is that, and I have said this again in the last time that we spoke, that this stability, this 10 years political calm that we have seen, in which India has gone from being a minnow economy. I mean, when the UPA came to power, India was about, I think, $350 billion, $400 billion economy. We are now a nearly $2 trillion economy. I mean, in the early part of the 2000, if you went abroad, you were looked down upon as an Indian. In the last 10 years, in particular, since 2008 when the recession began, as an Indian, you felt very good going abroad, because there even the taxi drivers or, the waitress in a Starbucks would say that, hey, you guys are doing really well. We are hurting, as in America is hurting or Europe is hurting. But you guys are doing well. You're still growing whatever, 6%, 7%, 8%. China was growing, up, about the same, while the rest of the country, the rest of the world was hurting. So we were feeling good about ourselves. All that is going to be washed aside if a government other than the UPA comes to power. And I've said this unequivocally. The consensus trade is that the UPA goes out, and that is the bigger consensus is that their going out will be good for the economy, good for the market. I think that will be an utter disaster.